Hello, welcome back. So in today's video, I'll be talking about stocks that the market hates right now. So in today's video, I'll be covering a few things. We'll be covering the stocks that the market hates, your market valuations right now, as well as some questions that you guys have left me in the comment section below. So let's talk about the stocks that the market hates right now first. And the first stock is Pool Corp. So Pool Corp is a company that is down 12% year to date. It is currently trading at a 27 times earnings and it's near its 52-week low. So for Pool Corp, this is the company's mix of products. What they basically do is they sell everything related to your pool. So they sell the pumps, they sell the chlorine, they do maintenance, they sell the materials needed to construct your pools. And for Pool Corp, it holds a monopoly in the US in the pool industry. And so for Pool Corp, they have around 60% of their revenue coming from maintenance and repair. So that's a recurring source of revenue. And for Pool Corp, the amazing part of the business is they can have an installed base that is increasingly growing throughout the years. And that is increasing amounts of recurring revenue coming into the business itself, because more pools leads to more maintenance and so on. So for Pool Corp, it's a high quality business, and for Pool Corp, it is facing cyclical downturns right now. So the pool market globally is projected to grow around 8.6% all the way until 2033. And for the US itself, the US pool construction is projected to grow around 3% from 2024 to 2032 as well. So for Pool Corp, only about 15% of their revenue actually comes from the pool construction. The remaining 85% of the business is somewhat recurring for the business. So for Pool Corp, they have a recurring stream of revenue that is increasing over the years coming into the business. And that is why Warren Buffett has been buying into this stock. So for Pool Corp, here are the metrics. So you have ROE of 31%, which is quite high. You have ROIC of 14%, ROA of 9%. ROIC of 14% is actually quite high for a retailer like Pool Corp. But for Pool Corp, the margins have been declining over the past few years. So the gross margin has dropped from around 31% to currently now at a 29% mark. The profit margins have dropped from around 12% to currently around 7%. So here are some of the headwinds facing the business right now. So number one is just the normalization of post-COVID growth. So post-COVID, people spent a lot of their stimulus money on pools, and that led to a boom in your pool sales. But currently now we're undergoing some form of normalization. The housing market in the US is weak as well, especially with your high interest rate. So high interest rate leads to less houses being built, which leads to less pools being constructed. And for Pool Corp, it is experiencing lower margins as well because of the lower sales volume. So for Pool Corp, around 15% of their revenue actually comes from chlorine sales. And if you have to look at the chlorine commodity price itself, chlorine prices have dropped drastically over the past 3 years. Because for Pool Corp, the SG&A cost is still relatively stable. It hasn't come down over the years despite the reduced revenue. And that's why you're seeing operating margins as well as the profit margins coming down over time. So for Pool Corp, this is my DCF valuation for the company. So assuming an 8% growth for the first 5 years for this company, then assuming a 5% growth for the next 5 years, from year 6 to year 10, this company's fair value is at around $264 a share. So before COVID, they were actually growing at a very fast rate as well. They were growing between 10 and 15%. So this looks quite conservative on the surface. But if you were to bump this up to around 10%, meaning to say you bump up the free cash flow growth rate to around 10% from year 1 to year 5, this company has a fair value of $286, so it's currently trading at around fair value or so. So for Pool Corp, I think it's a quality business that is trading on depressed earnings right now, and that's why I'm seeing Warren Buffett buying into it. He likes buying stocks when the sentiments are terrible and when the industry as a whole is going in a downtrend. It is much better than buying stocks in industries that are going in an uptrend. So for Pool Corp, they will likely recover in the future. Your total addressable market in the US is massive in terms of your pools. People will get wealthier, people will spend more money on pools. And I expect Pool Corp to recover from this in the near future. So it's a stock that I'm considering right now. Next stock is Lululemon. So Lululemon this year is down around 35%. It is currently trading at a 16 times earnings, one of its lowest historical valuation. And it is trading right near its 52-week low. So for Lululemon, if you have to look into their earnings itself, the earnings were quite amazing across all fronts except for the American portion. So the American revenue went up 3 to 4% on a constant currency basis. Comparable sales down 2% or 1% on a constant currency basis. So overall for Lululemon in the Americas, the revenue is slowing down. The revenue growth isn't as drastic as what it experienced over the past few years. And the American portion actually still makes up around 70% of their total revenue. But the good thing about Lululemon is they are expanding abroad as well. So in China, the revenue grew at 21%. That is amazing. 7 to 8% comparable sales growth, and that makes up around 16% of the revenue. And then the rest of the world also went up around 16%. So overall for Lululemon, apart from the American portion itself, which makes up around 73%, the other portions of the business are still growing rapidly. And you can expect them to continue doing so, especially with the new store openings as well. So for Lululemon, apart from the revenue growth in all those countries itself, they also increase their margins over time. So margins increased from 57% to around 58%. So this shows that Lululemon still has the ability to increase prices, especially in an economic environment that was poor in Q1. So overall, this business is operating quite well. But the problem with the business is its industry. So companies like Lululemon, they come and go very quickly, and unless they have a very strong brand power, the company will grow quickly for a few years and then they will disappear after that. So fashion companies without a heritage, they usually avoids because there's no staying power for them to maintain their share in the future, and that's why companies like Lululemon, they are in a void. Companies like Deckers, on and on, all these different clothing and footwear companies, they're typically avoids because they'll have to constantly innovate to stay ahead of the game. Unless they have some form of brand power or brand image attached to it, it is almost impossible for them to maintain their share over time. Next company is Pepsi. So Pepsi this year is down around 12% year to date, currently trading at a 19 times earnings and a 4% dividend yield. So for Pepsi, the problem with the business is that a lot of its free cash flow, in fact, all of its free cash flow is used to pay out dividends. And that is bad for the company because the company is using acquisitions for growth. And when you have all your free cash flow used for dividends, that means that the company doesn't have any more free cash flow to go and do acquisitions, to go and do buybacks and so on. So for Pepsi, they've been very reliant on pricing of their products. So the volumes have been declining for a few years already. And almost every single year, they've been increasing their prices at quite a drastic rate as well. So in 2022, they increased prices from between 15 to 17%. That was quite drastic. And currently now, they're still increasing prices at around 3%, with volume dropping at around 2%. So for Pepsi, this is my summary. So Pepsi's main source of growth is pricing and acquisitions. They need to raise debt for acquisitions because they can't use their free cash flow anymore. That's bad for the company because it increases leverage. And when it comes to owning stocks, you don't want companies that increase their leverage for more growth. It will eventually hurt them in the future. And pricing will squeeze the consumer to switch as well. So over the past few years, Pepsi has enacted incredible pricing power. It's a double-edged sword as well because when you increase your prices, what happens is your consumers will start pushing back and then your volume start to decline, and then you have to increase your prices. So it's sort of like a spiral that leads Pepsi down a bad way. So for Pepsi, it is an avoid. It is a company that is highly leveraged, and unless it drops to a cheap valuation around a 15 times earnings or so, I don't think this company is a buy today. Next company is an interesting one. This company is Berkshire Hathaway. So Berkshire Hathaway, from its all-time high of around $540 or so, is down around 10%. So for Berkshire, what you can do to value the company is to value it based on price to operating earnings. So the stock right now has a market cap of around $1 trillion, and the operating earnings last year was 47 billion. So it's currently trading at a 22 price to operating earnings. So for Berkshire, it is like a staple stock that will grow along with the general markets and it will go down less in a broad market sell-off. It's almost a buy and hold forever company, but the problem is the valuation today is not great. So it's currently trading at a 22 times price to operating earnings, and it's generally not cheap as compared to the markets itself. So for Berkshire, that's why the company has halted their buybacks, and that's why I don't think it is a buy today, but it's a quality company that the market hates right now. It is down around 10% from its all-time highs already in the past 2 months alone. Next stock is Apple. So Apple is an interesting one. The stock is down around 18% year to date, currently still trading at a 30 times earnings. So for Apple, it is an expensive stock trading at 30 times earnings with no growth, with little AI, and the markets want something from Apple, and Buffett wants more as well. So Apple is facing challenges to its dominance right now. It needs to innovate or risk getting left behind. So for Apple, the metrics are incredible. So ROIC is incredibly high, ROE is incredibly high as well. ROE is upwards of 100%. Apple's metrics are amazing, but the problem with the business itself is they cannot use this cash and reinvest into the business because there's no way for them to reinvest and grow the business itself. The reinvestment rate currently is at around 2.7%. So if you're to take 2.7% and multiply that by around 46%, that is less than 1% growth for this company alone. So for Apple, that's why you're seeing them do continual buybacks because they can't reinvest into the business for more growth. And if AI fails, Apple will be the biggest winner because it is staying out of AI now. But if AI continues, then Apple will risk being left behind. And that is the challenge for Apple today. Next portion, I'll be talking about market valuations right now. So for the market valuations, the markets are generally overvalued. So this is from FactSet. The forward price to earnings ratio is at around 21.6 times, and it is higher than its 5-year average of around 19.9 times, and above the 10-year average as well, which is around 18.4 times. So clearly the US market is overvalued, but if you're to look at the S&P 500 equal weighted, the equal weighted portion is still slightly overvalued, but it is not as elevated as the actual price to earnings shows, because the S&P 500 equal weight is now trading at a 17 times forward earnings. So this shows that there is high concentration in the largest companies in the US. And the question that you should be asking yourself is, do all these larger companies deserve a higher valuation? Maybe they do, but this is expensive as well. So the US market is generally overvalued, and that's why you're seeing Warren Buffett selling out of his positions. I think there are better opportunity elsewhere as well in other countries, and that's why I've been looking into Chinese stocks and so on. Next portion, I'll be talking about some questions that you guys have left me in the comment section below. So the first one over here, it says consumer discretionary, LVMH, Alibaba, Pool Corp, Hermes, am I a joke to you? So Hermes is a company that is incredible. It's incredible brand value. In fact, the luxury chain goes like this. It goes from Hermes to LVMH and Richemont, followed by all your different other cheap luxury products. So for Hermes, it's clearly the best luxury brand out there, but the problem with the business itself is it never trades at a cheap valuation. It has always been upwards of 40 to 50 times price to earnings. And for Hermes, it is almost impossible for you to buy this company at a discount. And that's why I didn't include it in the list. But if you're to ignore the valuation and focus on just the business quality itself, then of course, Hermes is one of the best consumer companies up there. But for Hermes, it's a simple story. It's a company that is just too expensive. It will never come down to a cheap enough valuation for me to want to enter. And that's why I excluded the company out of the rankings that I made the other day. Next comment, it says, sorry, I have to disagree with you with Amazon. It is the only mode biz that dropped up to 94% in stock price in history. Although we can argue that it is only a short-term fall, but it resulted in a lot of margin calls in that time. So I consider it as a highly volatile stock instead of the best stock in my opinion. So for Amazon, yes, it dropped 94%, I think in the dot-com bubble also. But for Amazon itself, the company is now a lot bigger than what it was back in the day. Another thing, so try not to attach the business quality to the stock price itself. Sometimes the stock price can tell a very different story. So when it comes to owning stocks, try your best to detach the stock price from the actual quality of the business. Sometimes a quality business can go down 30-40% or go up 30-40% when it doesn't make sense because it's just the market swinging. It's all Mr. Market. So for Amazon, I view it as a high quality business. Yes, it can be volatile sometimes, but detach the stock price from the fundamentals of the business and you will feel a lot better. I hope you guys have found this one useful and invest safe.